Last year, CarMax dropped their earnings report, and the numbers were absolutely shocking. Revenue was down over 5%, repossessions rates hit record highs, and they were sitting on $3.6 billion in inventory they couldn't move. But here's what was really wild. While they were selling fewer cars and bringing in less money, their profits were actually going up. How was that even possible? And what does this mean for anyone thinking about buying a car from America's largest used car retailer? Today, we're breaking down all the information about CarMax's crisis, so stick around till the end, because the data we uncovered will blow your mind. Let's start with the facts that CarMax couldn't hide. Their retail sales were down significantly, but here's the truly outrageous part. They were actually making more profit per car while selling fewer vehicles. They figured out the perfect scheme: make customers pay more while spending less on their own operations. Over the past 4 years, the average price at CarMax had skyrocketed by 35%. We're talking about an average car price of $27,000 in 2024 compared to around $20,000 back in 2019. That wasn't inflation. That was price manipulation on a massive scale. But the pricing pressure wasn't over. With Donald Trump's return to the presidency and his proposed tariffs on imported vehicles and auto parts, car prices could face another major shock. Trump's tariff policies could potentially add thousands more to vehicle costs, as many cars sold in America contain foreign-made components or are manufactured overseas. This meant CarMax's already inflated prices could climb even higher, putting vehicles further out of reach for average consumers. A recent analysis of CarMax inventory revealed exactly how these inflated prices translated into real-world shock for consumers across different vehicle categories. In the sports car segment, the pricing reached absurd levels. A 2022 Dodge Challenger Scat Pack with just 3,000 miles carried a $50,000 price tag. Even a 2021 version with 19,000 miles was still priced at $39,000. These were pre-owned vehicles with significant depreciation, not brand-new cars fresh from the factory. Family vehicles demonstrated equally shocking markups. A Toyota Sienna from 2012, representing 11 years of age, with 58,000 miles was listed for $21,000. The idea that an 11-year-old minivan could command $21,000 highlighted just how disconnected CarMax pricing had become from market reality. For budget-conscious shoppers, the situation was even more disheartening. The cheapest vehicles on entire parking lots were typically models like a 2014 Volkswagen Jetta with 109,000 miles priced at $12,000. This was CarMax's amazing solution for budget shoppers, a decade-old sedan with six-figure mileage for only $12,000. Perhaps most problematic was the mainstream sedan market, where CarMax's pricing strategy completely undermined their value proposition. A 2023 Toyota Camry with 28,000 miles carried a $26,000 price tag, while consumers could purchase a brand-new equivalent with 0 miles for just $26,000 to $28,000. This pricing approach essentially eliminated any rational reason for customers to choose used over new. While CarMax struggled with overpriced inventory, another crisis was brewing beneath the surface: a record-high number of people failing to pay their car loans. The types of cars flooding repo auctions told a devastating story about American consumers. Sports cars and muscle cars are on the top of the repossession lists. Challengers, Mustangs, Camaros, Chargers, all the high-performance vehicles that people had purchased when money was cheap and times were good. These expensive, high-payment vehicles became the first casualties when families faced financial pressure, creating a wave of repossessions that revealed just how precarious many car buyers' financial situations had become. CarMax was literally repossessing cars from their own customers and then selling those same vehicles at auction. Think about that. They sold someone a car, financed it themselves, then took it back when payments stopped, and sold it again to make money twice on the same vehicle. When a company's business model includes profiting from their customers' financial failures, that's not just a red flag. That's proof the business model is rotten to the core. CarMax was essentially operating the world's most expensive car graveyard, with $3.6 billion worth of vehicles slowly deteriorating in parking lots across America. Every month these cars sat unsold, their value plummeted in a market where prices were falling rapidly. This wasn't just a cash flow problem, it was a ticking financial time bomb that threatened the company's entire foundation. The situation grew worse as the vehicles themselves began to deteriorate. Used cars are inherently problematic. They've been driven hard, require constant maintenance, and when they sit motionless on parking lots for months, batteries die, rubber seals crack, and what dealers call lot rot sets in. Cars are engineered to be driven regularly, not abandoned in storage. This created a vicious cycle. Billions of dollars worth of depreciating assets sat in parking lots nationwide, eating up massive carrying costs while losing value every single day. The automotive industry had unleashed a financial monster that was now devouring American families whole. Millions of car owners had become prisoners in their own driveways, trapped by the largest consumer debt disaster in American history. The force threatening to destroy the entire used car market is negative equity. Over the past 2 years, more negative equity had been generated than in all previous decades of automotive history combined, creating a financial catastrophe of unprecedented scale. Customers who had paid market adjustments and inflated prices during the pandemic found themselves trapped in an impossible situation. They owed an average of $6,000 more than their vehicles were worth, making it financially impossible to escape. Trading in a car required covering that $6,000 gap plus finding money for a down payment on yet another overpriced vehicle. 2 huge expenses most families couldn't handle. The reality was crushing. Most Americans couldn't scrape together $500 for an emergency, let alone $6,000 to cover negative equity. This reality was driving millions of potential customers out of the market, creating a death spiral that explained why sales volumes were collapsing across the entire industry. The people CarMax depends on are financially trapped and can't buy anything new. Here's something that might surprise you. CarMax management wasn't necessarily evil. They were trapped in a system that forced short-term thinking over long-term customer relationships. Unlike small business owners who can pivot quickly and think long-term, public company executives have to answer to shareholders every quarter. They can't afford to slash prices now to build customer loyalty for years down the road. They need profits this quarter to keep their jobs. This pressure forces decisions like keeping prices artificially high even when they know it's hurting sales volume. They're pinned down by shareholder expectations and can't make the obvious move of lowering prices to move inventory. The most damaging trend for CarMax is that their used car prices are often higher than new car prices for the same models. This completely undermines their value proposition. Ford Mavericks at CarMax are selling for over $30,000 when they were designed to be affordable trucks starting around $25,000 new. A used Toyota 4Runner with 42,000 miles costs $35,000 when similar new models might be available for comparable prices. This pricing strategy might work when new car inventory is scarce, but as new car availability improves, CarMax's business model collapses. Why buy used when new costs the same or less? CarMax's struggles aren't happening in isolation. They're a leading indicator for the entire used car market. As the largest used car retailer in America, when CarMax has to lower prices, every other dealer follows. The combination of negative equity, high interest rates, inflated prices, and record repossessions is creating a perfect storm. The market correction that's coming isn't going to be gentle. It's going to be dramatic and painful for anyone caught holding overpriced inventory. For consumers, this crisis represents both danger and opportunity. Danger if you buy at current inflated prices, but opportunity if you wait for the inevitable correction. Management teams across the industry are facing the same impossible choice: maintain margins and watch sales volume collapse, or slash prices and face shareholder revolt. Most are choosing to maintain margins, which means the correction will be delayed, but more severe when it finally comes. The used car market built on inflated pandemic pricing is finally crashing back to reality. CarMax's struggles are just the beginning of a much larger reckoning that's coming for the entire automotive retail industry. If you found this look at CarMax's crisis valuable, make sure to subscribe and share this video. The used car market is changing rapidly, and understanding these trends could save you thousands on your next vehicle purchase. What do you think? Should CarMax slash prices now or try to ride out the storm? Let me know in the comments below.